Hello everybody and welcome back to the Learn to Trade Smart Money Concept series. So this is going to be episode 6 and hopefully this is where we round up all of the course contents. Before then we move on to how we actually apply all of that to our analysis and to our trading strategy. So if you remember correctly, last episode we introduced Mr. Richard D. Wyckoff and we went through why he is relevant, what some of his concepts were, what some of his laws were, and then towards the end we actually brought up Wyckoff Schematics, which are very, very relevant as they represent the whole importance of step 3. So this episode is pretty much just going to dive into Wyckoff Schematics, what they are, and most importantly, how we use them as entry confirmation, as that is overall the step 3, the final step of the 3-step approach to the market, which to me makes up my smart money based trading strategy. So if you remember last episode, we started to touch on trading ranges. Now let's just have a small recap. We were sort of referencing, if you remember back in the first couple of episodes when we did market structure, we were going through market cycles, which was a case of us having a trend, a period of consolidation, a trend, a period of consolidation. So an uptrend, consolidate, downtrend, consolidate. That represented one market cycle. Now that tied into the fact that we also have Wyckoff price cycles where we have uptrend, distribution, downtrend, accumulation. And now that allows us to understand that periods of consolidation are not simply just periods of consolidation. They actually have a purpose, which is institutionally controlled in order to create a Wyckoff schematic. So let's walk through those. Always just remembering that distributions cause the market to go down, or distributions reverse the market down, accumulations reverse the market up. So this is relevant at all points in the market. So pretty much every reversal point is going to have some form of a Wyckoff schematic on some form of time frame. Now, if we were to look through all of this, we could go down probably to a low enough time frame to identify the fact that we have distributions, accumulations all along the way. I don't think we need to get too caught up on that. What we can, however, do is look at the lowest point in the market as of recent, where I believe on the Euro USD market we've had an accumulation on these higher time frames. So we can actually walk through why that is, how I can identify that. But to start off, let's just walk through a little bit of information on an accumulation. So from Wyckoff's price cycles, we understand that when price is oversold and the current markdown is coming to an end, as we can quite see evidently within this, we've had a prolonged period of a downtrend, a markdown. We see that as we've entered towards the end of this markdown, what's happened is the volume and spread of the bearishness is starting to diminish. If we actually look at the supply and demand in the market, the volume and spread, we can tell that this market was probably coming to an end. Well, why? Because our impulses are getting shorter, our corrections are getting longer, and there no longer seems to be enough supply for this trend to continue longer term. So what we've seen is after the downtrend, the market starts to curve off, we start to lose supply in the market, we get to an oversold state, at which point an accumulation is made. Now, I can tell that this entire region here is representing an accumulation. Now, how? How is it that I'm identifying this? Well, for starters, I can see quite a clear region of consolidation here where we have some boundaries. Now, if you remember at the end of the last episode, we were talking about how these schematics actually have boundaries, in which case we sort of have support and resistance within the schematic. So we can see that along this level here, however we may decide to interpret that or draw that on, there's definitely a clear level here that price is reacting from. Now, I would suggest that this is actually a level of support, therefore a level of demand. And on top of that, we also have this region up here that price has been reacting to as a form of resistance or supply. So we can see that we have this overall region that price is reacting within, but what happens is as the institutions bring price into this region, they create boundaries. And these boundaries are represented by supply and demand, or resistance and support. And that is representing the region within which price is going to consolidate within. And then we know that any moves outside of this trading range are going to represent manipulations and pretty much just things that the institutions are going to do in order to try and manipulate people into losses, whilst also actively manipulating the supply and demand balance. So the first thing we need to understand is accumulation events, the events that happen within accumulations. Because I can tell you that everything that happens inside of this has a name, can be labeled, and has a purpose within the overall schematic, within the overall idea of reversing the market. So let's go through those. As we start to enter towards the trading range, we see that what happens is we have created this level here. Now, if we were to drag this across, we see that this is the earliest point where we've actually identified this support turned resistance. And we can see that what's happened is we've bounced off it. Now, this is representing something called preliminary support, which is usually identified as PS. So all of these are going to have abbreviations, and we can go through what they are. So preliminary support. So this is the first sign that we are entering a level of support. You know that price is quite hesitant to move lower. We see that as we tapped into this region, we have created a level of support where we've reacted a couple times. From that, price is struggling to go lower. We've then traded down, reacted back from it. So pretty much confirming that we do have a parameter in the market here. So I'll actually read out Wyckoff's meaning behind the preliminary support. So this is where the substantial selling pressure begins to diminish and we find a pronounced support level after a prolonged down move. Price is showing signs of being oversold and we can visibly see diminished volume on the down moves. Substantial buying is beginning to enter the market. Volume and spread begins to increase on the retracements and we have a large reaction to the preliminary support. So the point being that as we've entered this region, if we look at the volume and spread of the candles, we see that it's diminished within this region. We see that as we've then tried to create another impulse lower, this impulse is very shallow. We've then instantly had a reaction and a nice deep correction wave back up. So these are pretty much just signs to us that supply is running at the market. And the preliminary support, although it's hard to identify upon its exact creation, we can identify that still as an early sign that the market is ready to reverse. What we then come down to is where we end this impulse. That represents an abbreviated to SC or a selling, if I can actually spell that correctly, selling climax. Now this is pretty much just representing the point in the market where the real selling power fully diminishes. You know, we have pretty much just reached a roadblock. We see that after we have that correction, we're retracing back down. We are just really struggling now at this point in the market to continue moving lower, and is therefore further confirmation that that downtrend is coming to an end because of the fact that we have created the selling climax. So again, I will read Wyckoff's actual explanation on this. So this is the point where the down move officially ends as the intense selling pressure has sharply diminished, or because the larger interests or the institutions are beginning to absorb the supply or the selling pressure in the market. This creates our lower side boundary for the trading range. We'll typically see a very wicked candle at the selling climax, representing the push down being absorbed by the larger interests, and then the beginning of price getting ready to push up. So what's happening here is that we understand longer term, if we were to look at this as a Wyckoff price cycle, we've had a large distribution here in the market, which means the institutions have loaded up on sell positions in this region. What happens is as we enter this region, as we come towards the selling climax, the reason why it is a selling climax is because what's happening is that institutions are starting to close on those sell positions that they've held for so long. Therefore, they are removing supply or absorbing supply. On top of that, because they understand that this is where the accumulation is starting, this is where they want to start getting involved in buys, they will start to actively execute small buy positions, again, helping to further absorb the current supply in the market. So After the selling climax, that's when we trade up, evident by this correctional wave, which takes us to the AR, which equals the automatic rally. Now, what this is representing is the fact that after we've hit that selling climax, or we have created that lower boundary, we've had quite an intense reaction from that. And this is evident by quite a high volume push up in this case, where we understand that this is a good sign that supply has been absorbed and that buy positions are being taken, because we've been able to have a nice high volume push up to create the higher boundaries of the trading range. So understanding that the selling climax and the automatic rally are two of the best things, or the two main things that we use to identify the parameters, because that is the very first major swing points we create. And then price will typically react alongside those points as the trading range continues to play out. So again, Wyckoff's version of an automatic rally, this event occurs because the selling pressure has almost fully diminished. A wave of buy orders is able to push price up with ease. The point at which this rallies to is used to set the upper boundaries. It's very promising if we see higher volume in the creation of the automatic rally, because this is proof that the larger interests or the institutions are beginning to get involved. So that is the automatic rally. We then come down to the secondary test, which is where we come to test the region of the selling climax, therefore helping us identify the boundaries, because we understand that price should react to some form or some level of demand or support in the market, which allows us to identify that secondary test, because we're coming back down to test that region to try and pretty much just gauge how much supply is left in the market. If we're able to surpass the selling climax or come much further down, obviously that's an indication that there is still quite a lot of supply. But in this case, where we've come down, we've had instant rejection. That is a very good sign that supply has diminished, demand is entering the market, and that is the purpose of the secondary test. It's pretty much helping us to gauge, or helping the institutions gauge, what the supply and demand balance is currently looking like as they enter this region. Okay, so the next notable event we have within this is usually created after the secondary test, where we see quite clearly after the creation and the reaction, we've had a very clear push through that lower boundary, which is why it's quite relevant for us to identify that, because this is the creation of something called the spring. Now, this doesn't actually have an abbreviation. This is quite simply known as the spring. And the purpose of this is to manipulate the trading range. So we see that we did actually create quite a clear level of support, where we've had one test, the secondary test. We've then seen a reaction, because we know, looking at this structurally, we've had a move down, a correction, a move low, which has come to surpass that low. So that should have been a protected high. So once we see price push through up and past that protected high, that is technically a break of structure and is technically confirmation for anybody looking at this as a level of demand or support. That is confirmation of an entry in their eyes, because we've had that lower time frame break. So what we know is that a lot of people are going to be getting involved in buy positions in this region, with the expectation that this is a reversal higher, that they're getting involved in a point of support, involved in buy position. So the institutions are seeing this as a concentrated area of liquidity. So the best thing that they can do is then push price through after manipulating people into buy positions, which we've clearly seen. We push price through. We then allow the institutions, or they allow themselves, to get the best possible price for buys, because this is the lowest the market will go within this entire market cycle, and therefore they are allowing themselves the best possible price that they can get for buy entries, therefore allowing themselves to profit much, much more. The other thing that is notable with a spring is that it's typically going to represent a fake out, where we see here that we've broken through the level of support. We've then retested that as resistance, started to make a move lower. So again, we have started getting people involved in sell positions, because they believe that this spring, they're not seeing this as a manipulation, which we ourselves thankfully do. Instead, they're seeing that as a break and retest, continuation of the downtrend, and opportunity for sell positions. We see that ultimately price does not follow this. We then enter back into the trading range, retest that level of support, manipulating all sellers in the market out of their positions, which is where evidently we have what is known as the test, which could actually be identified as any of these, because this move back down is a test of the spring, and then this move here is a test of the level of support. So all we need to know is that a level of a test is pretty much just representing where price, after creating the spring, has come back down to show signs that it is not wanting to move lower. It is also helping us test the supply and demand balance, because as we see, we have that move up. The institutions force price back down to test what the supply and demand balance is like in this region. We see the second we get back down, we're also mitigating the last sell to buy order created by the spring. And then we notice that after we test this high volume push up, we come to test again, mitigate positions out. And this time round, we understand that there is enough demand in the market because the reaction after the second test there has caused a nice high volume move back up. So what this move here actually represents is something called the LPS, or the last point of support. Now, the reason why this is relevant is because it is showing us that price was not actually wanting to hold down here. Instead, we've re-entered the trading range, retested this level of support, and therefore what was once support all the way down here, we have created a new level much higher. Therefore, we see that the levels of support are getting higher, which means there's more demand in the market, price is moving up, and price is struggling to go low or as low as it once was previously. We notice that as of right now in the market, we've then come up to test this level of what was once resistance into support. So this is also representing an LPS, or as we stated, a last point of support. So again, this is just representing the fact that our support levels are getting higher and higher every single time, because price is really struggling now to make any moves lower because of the fact that there is that much demand that has been entered in the market from this institutionalized reversal in the market. So this represents an entire accumulation in the market. There's maybe one or two events that haven't happened in here, but those events are very situational. They do not have to appear every time. The events that we have identified here, so the preliminary support, selling climax, automatic rally, secondary test, spring, test, and last points of support, they should always be present within any accumulation that we see within the market. They are the staples. There's one or two others that we don't really need to touch on that may occur every now and then within some accumulations. They don't need to be worried about. All we need to know is that these are the main events within an accumulation, and this is exactly how the institutions control a reversal in the market to stop a downtrend, absorbing the supply, manipulating people out of the market, and then creating an uptrend to then take price higher. So the good thing is this is relevant to us as of right now, because this has literally happened since, July of this year. So we've literally spent maybe 4 months now within an accumulation on this daily time frame. We have spent the last 4 months accumulating the market. So the institutions have spent 4 months actively absorbing the supply and introducing demand. So that is a very nice, relevant example. And what we would ideally like to see now, as is suggested by the fact we've accumulated, is the start of a prolonged uptrend, which should potentially take us all the way back up to mitigate the positions in this downtrend that was created all of last year. So now let's actually walk through. Now that we've got the accumulation event, we can now go through the accumulation phases. So a phase is representing periods of the accumulation and what that means. So first things first, we have straight after the secondary test, that is a representation of phase A. So all of this region here, everything to the left, is representing phase A and the very first phase of an accumulation. Now, the first phase of an accumulation outlines the ending of the previous downtrend. Before this point, we know that supply has obviously been dominant in the market because of the fact we were moving lower. What's happening here is that the institutions start to unload on any sell positions they've had held previously to help remove supply from the market. They also start executing small buy positions to help with the process of absorption of supply in the market. So phase A is pretty much all about bringing the previous trend to a halt or to a stop. So doing what they can to put the brakes on that downtrend so that they know, and this is the very first step they take within causing that reversal by removing supply, absorbing supply, and getting ready to curve that market off. So that is the purpose of phase A. And we can identify that because it will always represent the preliminary support, selling climax, automatic rally, and secondary test. The second we have the secondary test formed, that represents the end of phase A. So something that is actually worth noting, and something that I should have pointed out sooner, is that there's not always going to be one secondary test in the market, because we see that as a matter of fact, we've actually had 1, 2, 3 major reactions to this level of support, and each one of those 3 reactions represents a secondary test. Now, what we do is to identify phase A. It ends after the very first secondary test. So that is where the absorption has really stopped. Now, phase B, what phase B represents, if we actually quote Wyckoff here. So phase B, Wyckoff stated that phase B served the purpose of building a cause for the new uptrend. This is because it is within phase B where larger interests are accumulating low price positions as well as manipulating traders out of the market. The process of a real institutional accumulation can take as little as a few minutes to as long as a few years. Typically, the longer it takes, the easier it is to distinguish its events and phases, and therefore easier to trade. So it is within phase B that we may and probably will start to see more secondary tests created, as this is where, as we stated, the absorption has ended. The downtrend has already come to a halt at this region now within phase A, and phase B is all about understanding and building a cause. And what that means is that this is where the institutions start loading up on some sell positions, getting ready to push the price higher, and therefore building the cause, building the backing power needed for the new uptrend to begin. So phase B is pretty much just going to represent this small region after the first secondary test and just before the spring. We have phase A here, the very first phase. We then go into phase B, which again represents all the secondary tests after the first one. And then we enter phase C, which pretty much just represents the spring in the market. Now, if we quote Wyckoff, the purpose of phase C is to determine the price's readiness to be marked up, or how ready we are for the uptrend to be created. It is within this phase that the larger interest can test the remaining supply, if any. Once they know that all supply has definitely been absorbed, they will begin to look at manipulating the market and loading up finally on the remaining positions and shares that they would like to gain and accumulate within the market before the uptrend begins. This is obviously going to be notable, or we can actually identify phase C through the creation of the spring. So we see that the purpose here is what we've done is we've tested in this region using the secondary tests. Are we ready to start moving higher? So that is the very first sign we take of understanding if the cause is there. What then happens is we push through and create the spring. Now the institutions can actually understand the supply and demand balance, because we understand that at this point a lot of supply has been absorbed. So when the spring's created and we push through, we should not be able to hold price down this low for long at all. We should see a lot of rejection, because there is simply not enough supply left in the market to sustain price being that low. This is evident by the fact that once we've pushed price low through, created the spring, we've instantly seen a high volume reaction, a high volume move back up, which is an indication that price was really struggling to hold that low in the market. But then on top of that is an indication that the institutions have started to load up on their buy positions, hence the volume that we've seen created in this region, because so much demand has been introduced by the execution of these institutions creating those buy positions. So that is phase C. It's the manipulation of the market, because we know that we've given a fake out. Also the region within which the institutions start loading up on buy positions and decide and get ready to create that new uptrend. Now, phase D is pretty much just going to represent the region where price comes back into the trading range. So I'd argue that's pretty much up until this point right here, where we see that price re-enters our trading range. This is always pretty much going to be notable by all of these last points of support that's created. And if we quote Wyckoff once again, phase D, it is within this phase that we want to see the continued dominance of demand. We want to see high volume moves up to represent the fact that we have introduced a lot of demand, and this is the start of the new uptrend with all of its fuel still ready to continue pushing price higher. So he states this is obviously going to be notable by new levels of support that are created, evident by the event LPS, as we've got in this case, where we've come back up and created 2 new levels of support. We want to see price continuing to move higher like this. So following what Wyckoff was saying is very good, because once we see price then re-enter, look at the volume within this region. I mean, look at the fact that we have very high volume buy candles within this region, a very high volatility move higher with very minimal pullback. This is a brilliant sign that demand is dominant in the market as of right now, and that price is ready to move higher longer term. So that is what phase D represents. And let's actually draw these on. It's going to be phase C. And finally here we have phase D. Now, the final phase that we have is called phase E. That is obviously going to be the 5th and the final phase within the market, where we eventually see price leave the trading range. That is why I've stopped it here, or stopped phase D here, because that's where we've had the test, and then we've left the trading range and we're now getting ready to continue higher. So all that phase E really represents is pretty much just price leaving the trading range. At this point, demand is in full control. The uptrend is really in power. And then that's where we're going to see price just continue off longer term. And there we go. The accumulation has ended. So that's all the event. That's all the phases. Now it's time for us to look inside of distributions and do this exact same process. So let's zoom out and let's actually just use, I'm hoping this is a good example for us to use, but I'm saying let's just use the previous swing high we had in the market. So this entire region here, and analyze this as a distribution, in which case we can actively see a Wyckoff price cycle taking place, because now we're going to mark up and identify a distribution. We then understand we have this downtrend that we've had for a long time, and now we've recently just identified this accumulation in the market. So what we'll do is we'll identify this, we'll go through, I'll show you all the events, all the phases, so that you are then also confident in what a distribution is. So let's do the same thing. We'll identify this with a green box, which is what I use for Wyckoff. And now let's go inside of here. Now, if you remember last time, what was the very first thing I did? Well, I started or tried to identify clear regions of support and resistance within the market. Now, I think we can clearly see that we've had a lot of reaction from this level, which is actually going to represent our upper boundaries. And we'll go through why that is very shortly. So our upper boundaries, that's resistance or support. And then our lower boundaries is going to represent this little region along here, which again is going to be support or demand. Now, the reason why I've identified them here, if you remember when we went through the events last time, we used the selling climax and the automatic rally as the points of how we identified that. So as we come inside of here, the very first thing we have, like we did within an accumulation, although it's slightly different, we have this region right here, which is called PSY, or in this case, preliminary supply. Let's actually make that text smaller, put it to 16. Okay, so like we had with preliminary support, just on the flip side, this is the first sign that price is reaching a level where we're seeing hesitation of price to move higher. So this is the first evidence that supply is entering the market, because we've seen some hesitation in this region. The reason why it's slightly different is because this hasn't helped us identify any of the bounds within the market, because it's not reacted to the bounds that we've identified. So all we need to know, preliminary supply, just the very first evidence that supply is beginning to enter the market. We then come into the trading range. We see that we have created in this case, a buying climax, where what happens is we tap into this region. We have BC, or buying climax. And again, this is where price or the uptrend comes to a very climactic ending. As we see by this region, we had a high volume move up, and then we suddenly hit a level that we just cannot seem to penetrate, and we're having clear reactions back down from that climax. So again, we can actually quote Wyckoff on this to understand what it is that he exactly said. This event marks the real stopping power of the previous trend, so the previous uptrend. Volume and spread within the move up will be very low and will start to diminish. Any remaining demand at this point is starting to get absorbed by the larger interests. So, like it was within phase A of an accumulation, this is really where the absorption process begins, and the institutions are starting to unload any buy positions and start introducing some small sell positions. So, after the buying climax, we have the same thing, an AR, in this case an automatic reaction, because it's not an automatic rally, because it's not a rally, it's simply just a reaction in the market. So we have the automatic reaction, we have buying climax at this point, automatic reaction. We see that as we've entered this level, we've had a very high volume push straight back down. This is good for the automatic reaction because of the fact that it's showcasing the fact that a lot of supply is introducing itself within the market, because the second we've reached this region, we've had a very high volume move back down. You know, if we look throughout this, we've had very low volume moves down, just represented by wicks. And then the second we reach this region, we have a very big pullback. So that's pretty much representing the fact that at this point, supply is being introduced. Why is that? That's because demand's been absorbed and some supply has been introduced into the market through sell positions that the institutions have opened. These two events are helping us identify the parameters. And then, of course, at this point, because we've seen plenty of reactions after the fact, we know that these definitely do represent boundaries. But if we were at this point and we did not have any of this information, we would use these two events as parameters within which we can identify those upper and lower boundaries. Now, we see that after the automatic reaction, we've then had many secondary tests within this region. Where we see that price is testing this level of resistance or supply multiple times. We've bounced off this. So clearly demand is being absorbed because we're really struggling to push price higher at this point. Something that was not within an accumulation is something called a sign of weakness. Now what this is after we've identified our parameters, so our upper and lower parameters, we see then that price falls through and actually manipulates this region. So what this is it's actually an early manipulation of the trading range where we fall through. It seems like supply has taken control because of this high volume move that's come lower. What's happened is we've then retested on that level of support, tried to turn it into resistance. Now, what this actually showcases to us is that at this point we've absorbed a lot of demand and introduced a lot of supply because we've been able to push price lower through the bounds with such a high volume move. We know that there is now a lot of supply in the market. So we know that the institutions have been successful within absorbing demand because supply is starting to look dominant. We then trade back up into the trading range after manipulating some traders out of positions and come to test that upper boundary once again, which represents a secondary test in phase B. So now this is where we have that major manipulation, which is the pretty much counterpart of a spring, which is this entire move here, which represents an up thrust. Again, this doesn't have an abbreviation really. I typically just call it an up thrust. You may decide to abbreviate that to UT, but I usually identify that as an up thrust. Now what that is where the institutions now at this point, even though we have a clear level of resistance, they've executed a large buy position to push price through, represent a break and retest, continuation higher. The reason why we'd see this as a continuation high is because we broke structure. So we know that a lot of people at this point will start loading up on buy positions because they believe that the uptrend is still in control, that we are still moving higher. We've even had valid confirmation to enter buy positions because of the breaker structure, but we know that this is simply just a manipulation of the trading range where we have a fake out before we re-enter and continue lower. So we quote Wyckoff within this. The upthrust is a bull trap. This is where we are trapping buyers into losses. This is where the larger interests push price above the trading range, signaling a break and retest or a fake out. The public are now misled, believing a continuation of the rally before price then ultimately heavily reverses. It is likely to see price fall down to our lower boundaries after an upthrust, which is exactly what we see. We come back down. It is exactly at the upthrust, like the spring, where the institutions start executing major big positions. So in this case, major sell positions, which is why we've been able to have such a high volume push down, because they have introduced a lot of supply into the market. Now, one thing that we didn't actually identify within an accumulation is this move here, where we've actually manipulated the trading range for a second time. Now, what this is called is it's an upthrust after distribution, or a U-tap. Now, an upthrust after distribution is simply what I said it is. It is just a further manipulation of the trading range, where we see a break and retest, continuation higher, further manipulating people out of the market. This can actually happen when there's not quite enough supply to sustain the move lower. So what's happened is, as they've pushed price lower, we see the reaction here. The institutions might have gauged, right, I don't think there's quite enough supply to cause the move lower that we want to cause. Let's manipulate a few more people at the market. It's also at this point where they can execute more sell positions, because again, they're getting a brilliant price for their sells by bringing price up to here. They're also testing and mitigating any positions out of this region that needs mitigating. And then we see after that, we see price fall through, the downtrend starting. Okay, so again, the counterpart of a last point of support that we saw within an accumulation, in this case, is going to represent a last point of supply, or LPSY as its abbreviation. Now, again, similar to what we've seen in its counterpart, it's where we re-enter the trading range. We then react once again to this level of resistance, or known as supply. We are reacting to this, so we know that now where we were once seeing resistance or supply all the way up here, we have now moved that level lower. We then see the same thing again, slightly lower, where we then break and retest what was once support or demand, and then react to that as resistance or supply. And this is pretty much all of the events we really need to know. So I can even quote Wyckoff on the LPSY. Within our final stages, we will see more signs of weakness, which represent last points of supply. You know, we've seen where prices have fallen through. We retest, that's a sign of weakness. In this case, a last point of supply. Once this happens, we must assess the remaining demand in the market, or pretty much the readiness for price to move lower. We can see in this example that the moves lower we've seen so far have been at a very high volume, and the pullbacks have been very, very small. So that helps us to analyze the fact that within the supply and demand balance, supply seems to be very, very dominant within this region. So we've gone through the events. Now let's go through the phases, and we use a pretty similar parameter within identifying the phases within a distribution. So phase A represents everything to the left of the very first secondary test that is created. So that would pretty much just go, I would say, from this region. Everything to the left of that is representing phase A. And we know that phase A, similar to how it was within an accumulation, simply has the purpose of absorbing the previous demand that was already very dominant in the market, helping us to absorb that uptrend and get ready to tilt the supply and balance back into supply's favor to start the new downtrend. Phase B in this case can actually be slightly confusing, because it's actually going to represent this entire movement here, whereas in the last, or its counterpart within an accumulation, the manipulation or the spring was actually phase C. In this case, this is all going to represent phase B, so the sign of weakness, the secondary test in B, and it upthrust are all part of the second phase of a distribution. Now, it's within phase B, again, where we just build a cause for the downtrend. You know, we start manipulating people out to test how much supply is in the market. If we have the creation of a sign of weakness, that is promising, because it's shown us that price has been able to push lower, so a good sign that supply is in the market. We then see the fact that we've had the manipulation, the break and retest. So we know at this point, further people are being manipulated out of the market and institutions are starting to load up on sell positions, which is a sign that we are building a cause for that downtrend. Phase C is going to represent the UTAD. And if the UTAD was not present, as it is not always present in the market, it would represent the test. So imagine that price came down. We then tested this market before continuing lower. Phase C would simply just represent that test. So we can now move this, label this as phase C. And that's going to represent, and we can even quote Wyckoff again within this. Okay, so what is phase C? Phase C in a distribution trading range is notable by the UTAD. Now we know that an up thrust serves the same purpose as a spring, as it is a move through our trading range that signifies a continuation or break and retest before ultimately a reversal in the opposite direction. In this case, we are seeing this as a bull trap, as it is trapping bullish people and buyers in the market. The purpose of these events within phase C is to test the remaining demand in the market and start building and starting that new downtrend that is going to emerge after phase C. Phase D is where we start to see the creation of those last points of supply. It is where we have now, or the institutions have now, loaded up on all their sell positions. We know that supply is dominant from phase C, and at this point we just see price slowly moving down. We see that level of supply getting lower and lower and lower, as is an indication of the fact that the downtrend is now beginning. We then have phase E, which again, like the accumulation, is simply where price eventually leaves the trading range and the downtrend really emerges. So that is where the distribution ends. Now, let's quickly just recap over this. Phase A is where we start to absorb the previous trend. So in this case, we're absorbing the demand to really start getting the distribution ready, getting price ready to reverse. We're removing as much demand as possible. Phase B has the purpose of building the cause and also analyzing the current supply and demand balance that is left in the market after the absorption process has finished. We see that the sign of weakness is a great sign that there's a lot of supply in the market. Obviously, the upthrust in this case is an indication that we've manipulated people out of the market and introduced supply because of the fact that the institutions execute their positions at these manipulations. Phase C is pretty much just further manipulations and the real sign that supply is taking over because of the fact, as we see here, we've had a very high volume move back down. We can tell that by a volume and spread analysis, there is a lot of supply in the market. Phase D is where price starts to slowly emerge back down, slowly emerge outside of the trading range, giving further signs that supply is in control, as we can see evident by the fact that these levels of supply are getting lower and lower and lower. We see clear bearish structure being created. And then phase E finally is where price leaves the trading range and the downtrend is really in full control. So right there, we've gone through distribution, accumulation, all of the events, all of the phases. Now in the next episode, we're actually going to walk through why knowing all of this is relevant and how we use Wyckoff Schematics as entry confirmation. So the next lesson is going to have the purpose of rounding everything together, understanding why all of these last 6 episodes have been important, how we round all of that information together within our daily analysis, and how we use all of that as a brilliant trading strategy that I have found myself to be very, very profitable. This is where this episode is going to conclude. If you have any questions about Wyckoff Schematics, accumulations, distributions, make sure to leave a comment. I'll be more than happy to get back to you, walk through this, potentially even have a consultation call if there's anything that requires a bit more depth. So just remembering that at all swing points in the market, at a swing high, we're typically going to see a distribution formed. At a swing low, we're typically going to see an accumulation formed. And these will represent Wyckoff price cycles, as we said in this case, because we know we're in a downtrend longer term. What we're going to expect to see is distribution, a mark down, an accumulation, and mark up. This mark up should hold the previous high, come up to mitigate something, distribute lower than the previous high before creating a new mark down, which will come to penetrate the previous low so that we can continue higher time frame bearishness through the use of Wyckoff price cycles. So hopefully you guys have enjoyed this episode so far. Again, The majority of this has been quoted from my third PDF within the Beating the Banks course, which goes over everything to do about Wyckoff Schematics, and then at the end of the PDF, I actually go through in detail how we use Wyckoff Schematics to take positions, where's the best regions within a schematic to execute positions, and much more detail like that. If you are interested in knowing more about LAGFX, feel free to check out our website, or even get involved in the Learning Lounge, where we provide daily analysis, daily potential entry points in the market, so that you can see how we analyze the markets on a daily basis. But with that being said, hopefully you have enjoyed this video. Hopefully you've enjoyed episode 6. Make sure to smash the like button so I know that you are ready for episode 7, which is potentially the final episode within this series, where we round everything together and everything will finally begin to make perfect sense. So thank you everybody for watching, and I will see you next time in Learn to Trade Smart Money Concepts.